Move on to talking about the objectives of FX hedging. And in one of our previous presentations, we had touched on the fact that a lot of these topics that we are going over now or thinking about and presenting on came out of the Lloyds Bank Large Corporate Client Survey from Q4 2022. And as you can see on the bottom of this slide, the topics that people really wanted to hear a little bit more about were achieving budget rates, providing a competitive edge, and reducing earnings volatility. So in one of our previous Markets Masterclass pieces, we did discuss budget rates. And if you wanted to go back and have a look at that, please do. But the topic that we're going to be covering today is quite closely linked to that. And really, we just really wanted to kind of touch base on that and talk a little bit about common strategies that we do see clients employing and focus on what that means in terms of analysis, management, particularly of stakeholders, and objectives that hedging really is focused on. So, Colin, without further ado, I know you had some thoughts around this, but I'd love to hand over to you to get your thoughts.
Yeah, definitely. Thank you very much, Alex. And I completely agree with the introduction. So, yeah, the results that we've shown on this page are from a client survey, as Alex said, that we ran for our large corporate clients back in Q4 of last year. And some of the interesting things that came out of it, we put on this page. So, to me, number one, the number of companies that said they're going to be looking at their risk management strategy, in particular their FX and commodity risk management strategies in the near term. So at the time of the survey, either the rest of 2022 or in the coming year, was very significant, up at sort of getting on towards 90% of respondents, coupled with the topics that people said they wanted feedback on. So things like achieving budget rates, how can you use or should you use FX hedging to provide a competitive edge, reducing earnings volatility. All of these sort of topics play into FX risk management, and indeed, what the objectives of a risk management strategy should be. I think, as well as that, or possibly even behind that, what's driving those results. It's probably a number of factors. So, going back, obviously, 3 years or so, we've had COVID and the shock of that, and all the focus that brought on transaction hedging. If you think about cash flows that didn't materialize but had been hedged by companies, a lot of those got significant attention, and companies had to work through how to deal with that, whilst dealing with all the other issues at the time. Following that, we've had a return of FX volatility almost, meaning that there's more scrutiny on policies from sort of senior stakeholders, from external stakeholders as well, analysts, investors, and the like. If we go back to last year, there was a trend of US dollar strength. We spoke to a lot of our US companies. They were feeling that scrutiny, or almost sort of feeling the impact of that through the results of their dollar, the results that they reported in dollars of their overseas operation being worth less, so sort of overseas earnings being worth less. And again, you saw lots of questions coming through in earnings results and sort of investor presentations, people trying to get out ahead of that and deal with that. So all of that really means that companies and their treasury teams need to ensure that they understand the objectives of their FX risk management policy, and that those objectives, the policy itself, is clearly understood and articulated, and included in that is what FX hedging can achieve and what it can't achieve. I think needs to be very clearly understood by stakeholders within the company and indeed externally as well. So stepping back a little bit before we maybe get into FX hedging itself, it's almost worth looking at a bit of the wider context in which FX hedging sits. So that's what we've tried to do on this page. We've said that hedging is only a part of the wider risk management strategy. So what do we mean by that, first of all? Well, before you can arrive at a decision on whether you should hedge, what those objectives are, and how you're going to do it, you need to first understand the exposures that the company faces in relation to market risks. So first of all, on this page, we've tried to outline a typical sort of risk management strategy approach on this page. So first of all, we've said, in order to do that, you need to identify the risks and exposures. So this is really trying to answer the very simple question of, to what market risks is the company exposed? So if we took a really simple example, we could take a UK retailer, a clothing retailer, let's say, that was selling clothes only in the UK. So from a revenue point of view, it's earning revenues denominated in sterling, but it will very probably purchase the goods, etc., from suppliers potentially in Asia. It will very probably pay in US dollars. So that's quite a simple example of a mismatch in currency of revenues and currency of the cost base. So dollars coming into the company, sorry, sterling coming into the company, I beg your pardon, but dollars being the predominant cost base for those purchases. As I said, that's an obvious example. It's we would call that a transactional FX risk. So it's a risk that arises from cash flows. Those aren't the only risks to which a company is exposed. You also have, as I touched on earlier, translation risks. So that can be translation of overseas earnings. So I mentioned the example of dollar-based companies or dollar reporters last year facing a decline in the dollar equivalent of their overseas earnings due to the sort of trend in dollar strength that we saw, and that receiving a lot of focus. So again, analysts were questioning that. They wanted more information on it, and they wanted to know what the company's response was to that. It could also be translation of balance sheet items as well. So things like the net assets of the company or balances that are sitting on the company's balance sheet. So once all of those risks have been identified and understood, what's the next step? Well, some kind of quantification of those risks is the next logical step. So if you understand the market risk factors to which the company is exposed, can you then look to stress the potential outcomes? So can you look at stressing the FX rate? Can you look at different scenarios? Some companies use concepts such as value at risk or cash flow at risk, where they might apply a range of possible outcomes to the cash flows, the balances, etc., of the company to get a feel for what is the magnitude of these risks, and not only doing that from a cash flow point of view, but also following that through to some of the key metrics that the company reports. So things like revenues, margins. It might be a credit metric, so leverage, for example, net debt to some measure of earnings like EBITDA is quite a common approach. So having done that, you've now sort of identified the risks, you've quantified them. The next question to answer is, well, does the magnitude of those risks fit in with the tolerance that the company has? And that's really where we get into some of the drivers of the objectives of hedging. So, what is the risk? What is the consequence of some of these risks? What's the impact on the company? How does that compare to our competitors, etc.? So really sort of comparing the magnitude of the risks against the tolerance that the company might have to accept those risks or otherwise. And then finally, at the bottom of the page, we get onto FX hedging at long last, you may say. And this is really saying, well, what is the company's response to these risks? So if you think about sort of a classic approach to this, you might say, I can avoid them, I can pass them through, I can mitigate them, I can accept them. Some of these market risks, it's quite difficult to avoid, perhaps. Pass through is an interesting discussion that eventually a lot of market risks will be passed through to customers in the form of adjusting pricing. So that's one mechanism. Again, you've got to understand how your competitors approach that as well. Do you look to mitigate the risks? And that's really where hedging comes in. Or do you accept the risks because you think the magnitude won't have a significant bearing on the company's outcome? So we're focusing in the rest of this presentation on the mitigation part of this, to actually hedging the risks that we're talking about.
Just a quick question
Yeah.
from me. I mean, throughout this process, obviously you spend a significant amount of your time talking to clients directly about either quantifying those risks or establishing the risk tolerance. When you think about how you interact with clients or clients' treasuries and how they should interact with their banks, at what point should clients really be thinking about involving their banks or help from somebody like you in terms of walking through this process?
Yeah, it's a really good question, I think, Alex, and that is a large amount of what we and the likes of our teams in banks would do, and I think this is an area where we really can offer additional resource analysis, sort of value add to customers. Because if you think about trying to, even stepping back, sort of quantifying the risks, you think about typical disclosures in companies' accounts, there might be a very blunt sort of sensitivity analysis that says we will stress the FX rate by 10% and see what happens, sort of thing. Yeah. And that takes no account of things like correlations, how different risks sort of interact with each other, etc. So yeah, that's definitely something that we can help with. And this is part of an ongoing dialogue with most companies, from the start of this sort of top of this page, if you like, to the bottom.
So you could be involved at any step, really.
Absolutely, yeah. So helping the company to identify, to quantify, to think about sort of risk tolerance, and then if the answer is that they want to mitigate some of these risks, then again, that's a large part of what we do together with yourself, obviously, developing hedging strategies designed to do that and to meet those objectives.
Fantastic. Okay.
Yeah. So moving on. Getting into the title of the presentation and the objectives of FX hedging, there are probably two parts to this, you could say. So one is, why hedge in the first place? And just, going back to the previous slide, it touches on some of the points that we raised there. Why should the company hedge? And then there's the how to hedge question. So on this page, we've touched on some of the call them sort of discussion points almost, but there are different viewpoints. There's different stakeholders involved. And different factors that may be relevant. So just to run through a few of them quickly, some of these factors that might sort of play into the objectives of FX hedging and FX risk management. So number one, if you think about it from a shareholder's point of view, you might ask, well, what do shareholders expect from the company? So if, for example, if you're a UK company, you're reporting in sterling, do your investors expect stable sterling profits and returns? In many cases, they might do. Or do they actually have more of a look through to the market risks to which your company is exposed? And maybe one or two simple examples of that may be, just stepping away from FX for a moment. If you think about a UK water company, it will have a significant amount of UK inflation risk in it, and investors in those sort of companies may actually want that exposure, so therefore would perhaps not expect the company to hedge the exposure away. They actually want sort of pass through to the returns that the investors are getting. Another factor here is that, thinking about listed companies, shareholders very much don't just own one company, they'll own a portfolio of different companies. So there is the sort of slightly academic question of, well, are there offsets within that portfolio? If one company has an FX exposure one way around, the second company has it the opposite way around, the shareholder in theory isn't exposed to any net risk, perhaps, unless the companies then go and hedge it out. So that's one viewpoint that comes up. Secondly, what have we put on this page? So reducing cash flow or accounting volatility. Well, this to me is the main stated objective of a lot of FX risk management policies and hedging policies. So if you pick up companies' accounts, this will generally be the main objective that you see in a sort of FX risk management section. It's probably worth asking the question, why are the companies looking to reduce cash flow volatility? So what does it achieve? Is it a good thing in itself, having cash flows that are not volatile, or indeed accounting results that are not volatile? So you can obviously have accounting volatility without cash flow volatility, but what does it actually achieve in itself? Does it achieve a higher valuation for the company because its cash flows and therefore its returns are more stable? That's definitely one school of thought. Some of the other factors on this page then follow almost from that reduction in volatility or that objective to reduce volatility. So more stable cash flows might help the company to avoid financial distress. And what do we mean by financial distress? Brushing up against financial covenant limits, for example, where you might run the risk of breaching a financial covenant. It could be deterioration of the credit standing of the company, for example. Or moving on to number 4, then looking at debt capacity. Generally, companies with more stable cash flows will have a greater ability to raise debt from their banks or from the market. And that in itself might be a driver of valuation for the company. So if it can access more lending, it can reduce its sort of weighted average cost of capital and, in theory, benefit from a tax shield of that debt. And therefore, that might drive the valuation of the company. Other practical factors, which maybe some of the academic lenses don't particularly deal with very well, is just having the ability to forecast, plan, report, to your shareholders, to your stakeholders. A lot of that is enhanced through the risk management process and indeed the hedging process, that you have line of sight of the relevant market rates that will impact your results over the forecasting or the planning period. That plays into the ability to make investments and to sort of understand what the return from those investments may be. So that's a quick whistle-stop tour of some of the main factors that might drive the objectives of FX hedging. Maybe the final one to touch on that page, in the interest of time, is the competitive position. So all of these factors are well and good, and you can analyze them looking at the company itself. You can look at the sort of cash flows of the company, its strategic objectives, but clearly the company doesn't exist in isolation. And one key suggestion we would make is that companies should be very aware of their competitive position, and by that we mean how is the company exposed to market risks relative to its peers? How is it dealing with them? Is it in the pack? Is it an outlier? If it is an outlier, is that by design, or is that just sort of is that just a historic sort of fact? So that is quite important as well. And indeed, if you are in a sort of different position to your competitors, as I said, understanding why can be quite an important factor in all of this.
Good.
So
just from my side, I mean, it strikes me looking at some of these, from a real world example, that some of these can from time to time get conflicted as well. I remember from a bit earlier in my career, I had a US manufacturing client that had a significant chunk of their revenues, say 50 or 60% of their revenues in sterling at the time. At the time, cable was in the high 190s, and I spent quite a bit of time with the group treasury talking to them about given the high purchasing power parity of sterling, that maybe they should put a strategic hedge in place to protect some of those sterling revenues. And the group treasurer was of the opinion that shareholders were buying the stock because of the diversity of the revenue stream, which was the case in point at the time. The share price was very strong, but when we saw sterling fall against the dollar precipitatively, the share price really sold off very, very heavily as shareholders reduced their exposure, given the perceived risk of some revenue risk from the move in underlying sterling rates. So it's kind of interesting that when you think about it, their view was that the shareholders' view would win through, but the reality of it is they weren't thinking enough about maybe 7 or 3 or 8, where they were thinking probably 7 or 3, where maybe they need to stabilize the downside risk or think a little bit more strategically about avoiding financial distress situations. So it's kind of interesting to think about where some people are very focused on 1, but potentially not focused enough on 7 or 3.
No, I completely agree, and it's a good example, and it's maybe an example of shareholders' views changing quite rapidly as well. That they quite like the upside, but when the downside happens, they might change their view rather quickly.
Yeah, and it might have been a good time for the Treasury to have pointed to the fact that they put in a strategic option hedge, anticipating that type of scenario. So that would have probably won them some value. But anyway, moving on. Sorry.
No, it's a very valid example and probably leads into the next slide quite well. So all of what I've talked about thus far is really the theory, if you like, and some of the factors that we touched on that might sort of play into the objectives of FX hedging and the risk management strategy. On the next couple of pages, we've taken a real world example, and we've taken this from the airline sector. So I suppose, first of all, why this sector? Well, it probably works very well for some of the things that we're talking about. If you think about airlines, and this is a European airline, what are their significant market exposures? Well, it's stated on this slide, where they've very helpfully put a section on risk identification and potential impacts. But their material exposures are, first of all, to jet fuel. So obviously they have to buy significant volumes of jet fuel, and it's a very large proportion of their overall cost base. And to US dollars. So jet fuel is traded in US dollars. Things like leases on aircraft, for example, will generally be US dollar based, purchases of aircraft, etc. So they have a significant dollar cost base, and clearly a significant proportion of that cost base is fuel as well. So the company in this case has got some pretty good disclosures in my humble opinion. So first of all, thinking back to the slide a couple of pages ago, we have risk identification and the impacts of those risks. So the company has quite clearly stated what it's exposed to, as I've tried to outline, and what are the potential impacts to movements in those market risks. Well, they say that substantial price increases, adverse exchange rate movements could adversely affect profitability, fairly obviously. So that's sort of the identification of the key risk, if you like. They talk about fuel costs as well, having a material adverse on the company's potential financial performance. Beg your pardon. So those are the significant risks, as I've outlined. So what are they doing about those risks, having obviously identified them and talked about some of the impacts? They've developed their risk management strategy, and they've pretty clearly articulated some objectives of what it is they're trying to achieve in the bottom half of the page. So they've said the objective is to minimize the negative impacts of these market movements on the earnings, the cash flow, and the equity of the company. So just going back to some of the earlier points on cash flow, sort of transaction risks, translation of earnings, translation of the balance sheet, etc. The company has sort of covered some of those points in this statement. They have also said that while they can hedge some of these risks in the near term, they cannot change the sort of structural exposures of their industry fairly obviously, so that in the longer term they will always be exposed to these risks essentially. So that the company in question is a European airline. It's earning revenues in euros predominantly and some sterling as well, yet it's paying out lots of dollar costs. It's not suddenly going to go and sell tickets in the US and US dollars, for example. That's it operates within Europe largely, so it doesn't have that customer base, so it can't really do anything to change the makeup of its FX exposures. Similarly, jet fuel will, one might say, always be priced in dollars, so that they can't change that exposure either. So they can hedge in the short term, but hedging broadly, buys you time and a degree of sort of certainty over the hedging window, but it can't do that forever. It can't sort of hedge away the risks in the long term. Is quite an important point, I think. So then, having spelled out the risks, the potential impacts, talked about the objectives of what they're trying to achieve, on the next page they say what it is they're actually doing. So what is their hedging strategy in relation to some of these risks? So first of all, they talk about wider risks than just FX risks. So the company uses various derivative instruments. They have cross-currency swaps dealing with some of their debt that they've issued in other currencies, so sort of balance sheet translation risks, if you like. They have interest rate swaps, hedging some of that debt into either fixed or floating, depending on their preference. They have FX forward contracts, and they have commodity forwards and options to deal with the jet fuel or the oil price risk. And they reiterate the goal. So what is the goal? It's to hedge operational and balance sheet risks. So not just sort of cash flow risks, but also some of these risks that impact balance sheet items as well. On fuel hedging, so the company tends to hedge through forward contracts. It also talks about optionality in other disclosures within the accounts, and it does that over an 18 to 24 month period. Which, what does that do in effect? It gives it a degree of pricing certainty. So the near-term exposures might be hedged with a higher hedge ratio, so a greater proportion of them may be hedged, and then that might sort of tail off the further out you get. But it gives it certainty such that it has the ability to sort of price tickets in the relevant currency, either euros or sterling, in what is a very competitive market, and take out that near-term risk of dollar strengthening and therefore moving against them. And also, fuel costs moving against them. So on the FX side, I've already probably touched on it. So hedging associated with the income statement. The company enters into a series of forward contracts. It's trying to hedge the variability of the cash flows from movements in FX rates. So that's for fuel, it's for maintenance and insurance costs. And what's the reason for that again? It's because they don't earn they don't earn revenue rather in a matching currency. And then they also talk about sort of larger ticket items, so capital expenditures. So again, lots of companies within the sector have significant orders with the airline manufacturers, so they talk about entering into FX contracts to hedge those risks as well, the aircraft purchase commitments. So that's an example, a sort of real world disclosure that we thought it would be useful to try and bring this to life a little bit. So it tries to link the theory that we talked about in the first couple of slides with a live example in practice in a sector that has large market risks exposures that, as I said, over the long term it can't it's not going to hedge those away. The next part of the presentation then talks about, once we've defined our objectives of the FX risk management strategy, how do we actually implement that? So what is the strategy itself? And there's different ways in which you can use things like FX forward contracts or options to enact some of these strategies. And each of these different approaches is designed to achieve different things. And again, there's sort of overlapping aspects between them. But just to run through three of the main strategies, the hedging strategies that we see in practice. So first of all, resetting. And we've tried to lay this out in the schematic in the page. So just looking at the bottom left of the page, what's happening here. So if we're sort of at time zero on the left-hand side of the chart, what does the company do? Well, it is going to enter into hedges. So let's say FX forwards in this case at the start of the period for all the exposures that occur in the relevant reporting period. So in this highly simplified example, we have said that period is 1 year, and the company has perfect forecasting ability and it wants to hedge 100%. So it will enter into a series of FX forwards quarterly or monthly. We've shown quarterly on this page to lock in the FX rate for the entire year for sort of each of the main cash flows in question for the year. What happens at the end of year one? Well, the company then does it again. It will put its hedges in place, largely at one point in time or very close together. And again, for year two, it will do the same thing. It will go and hedge the exposures. Again, in this simplified example, we've said 100% of the exposures over that 12-month window. So why might companies do this, and what does it achieve going back to the objectives? Well, the key thing that it is designed to achieve is a known FX rate for the period in question. So for the year in question, you can see that on the right-hand side of the chart. So because we've shown this for annual periods, if you look at the green line in the chart on the right, that's the sterling dollar FX spot rate. And then the red line shows what the hedge strategy would have achieved if it's enacted in this way, if it had been enacted in this way over the past 5 years. So you'll see for each year, there's a sort of a certain FX rate, if you like, in the red line. But one of the significant downsides to a strategy like this, it might be quite simple, I think, in some people's eyes, is that you get this sort of cliff edge effect. So from one period to the next, you haven't hedged any of the year two exposures in year one. So you're exposed to, where can you hedge at the start of year two? And that's why you see these sort of sudden jumps in the red line.
Yeah, I mean, I think from our perspective, in reality, this is quite a simple strategy, as you say, and it tends to be used by, for example, a fintech that has a stream of revenue flows going out the next year. At the beginning of signing that contract, they would set their budget rate and they would hedge out that year and then revisit it the following year. So it tends to be where your cash flows are very certain, and you can hedge out the next year, and what your budget rate you're trying to achieve is. So it's quite a simple strategy, but quite effective if you do have that resetting kind of scenario for cash flows every year.
Yeah, I completely agree, and I think that's a good example, Alex. So yeah, moving on to the next strategy, what else do we see? Maybe moving up the ladder of complexity, you might say. So the next strategy we've put on the page is rolling FX hedging. So what does this aim to achieve? Looking at the bottom left, well, what is the strategy first of all? Well, you might notice that the green lines on this page, so the hedges that are entered into at the outset, are exactly the same as those under the resetting strategy on the previous page, simply because you have to start hedging at some point. So again, over the hedge horizon, we've used 12 months for simplicity. We've said that hedges are executed sort of quarterly. Those hedges are entered into at the outset, and that locks in sort of the year one hedged rate. What happens then as we roll forward in time? So as we go from sort of time zero to the end of Q1, well, the first 3-month hedge will terminate. At this point, the company rolls its hedging forward. So it puts on another 12-month hedge to hedge the cash flows that are expected to occur in Q1 of year 2. And so on as the initial 6-month hedge rolls off, the company enters into another 12-month strategy for the cash flows occurring in Q2 of year 2, hence the name rolling. So the company continues to do this. And one of the effects of that is that the company is always hedged, in this case, 12 months ahead, so that the hedged rate that should be achieved is known in advance, if you like, at any point in the reporting period. Maybe the benefit of this over the resetting strategy is that over the course of the year, you get a degree of smoothing or averaging of the FX rate, because hedging hasn't all happened at one point in time, but the company is hedged, at time zero, at the end of Q1, at the end of Q2, Q3, etc. So there is a degree of averaging of the rate that is achieved over a financial year. Again, the chart on the right works in the same way. That the green line is exactly the same as the previous strategy. That's just the sterling dollar FX spot rate. The red line now is the hedged rate that has been achieved under this rolling strategy. You can see perhaps it doesn't look particularly smooth in this example. That's because we've shown it quarterly. If you were to show it on an annual basis, you would maybe see this sort of averaging that's occurred, that you're not locking in hedging at a single point in time, but you're averaging in as you sort of as you roll into those quarterly hedges.
Yeah, I mean, in reality, I think we tend to think of kind of retailers as using this type of strategy. So somebody who knows they're sourcing product in US dollars, they're going to be selling it in sterling, but there's a 6-month lead time from placing a clothing order in US dollars to actually hitting the shelves and starting to sell that product. Well, we know obviously some of the fast fashion houses are operating on some pretty tight margins. So the reality of it is they'll have a rolling strategy. At the moment, they'll probably be looking at their Christmas orders when things are very busy and putting a 6-month strategy in place to hedge that dollar risk for that payment to that product that they're going to take delivery of at Christmas time and then hit the retail shelves. So this is quite a typical strategy for that type of retail client, I would say.
Okay, then moving on to a third strategy, layering, and this is where it gets, again, slightly more complicated perhaps and operationally intensive, but again, this is a very common strategy that you see for transaction risks in practice, and FX transaction risks in particular. So what does this do? Well, we've said in the two previous strategies, both the resetting and the rolling, because we looked at them over a 12-month period, then each of those strategies gave you a known rate at the start of the reporting period, or in the case of rolling for any 12-month period looking forward. Layering achieves something slightly different. So again, how does the strategy work? You'll see a slightly more complicated diagram in the bottom left, where the company looks to build up its hedge profile over time. So instead of going and hedging 100% in our simplified example on day one of a future forecast exposure, the company might only put in place 25% hedging. So the sort of the top green arrow in the bottom left chart. So for its exposure that's forecast to occur in 12 months' time, the company has hedged 25% of that exposure at sort of day one, if you like. As you then move forward in time, the company builds up the layer of hedges. So it puts on another 25% 3 months later, and again, another 25% hedge 3 months later, such that any exposure is hedged by a number of different transactions that have been built up over time. Again, in this sort of simplified example, it's 25% is added every 3 months. So the hedged rate that should be achieved for the exposure in question should be the average of those 4 hedges that have been entered into. So the one at time zero, at the end of Q1, Q2, Q3, etc., for an exposure that's occurring at the start of year 2. So that's hence the name layering. So the hedges are built up in layers as the transaction date gets closer. What are some of the benefits of this strategy? Well, if one of the objectives of your FX risk management approach and strategy is to smooth the impact of market FX movements over time, then the chart on the right shows that this helps to achieve that much more than the previous two approaches that we talked through. So you'll see, I mean, again, the chart works in exactly the same way. The green line is the FX spot rate, sterling dollar again. The red line is the achieved rate, and you'll see the steps in the red line now are much more, they're much smaller. They're perhaps much more manageable, therefore, from a reporting point of view. And that's because of the layering and the averaging that's sort of been achieved under this strategy. One of the things it doesn't do, perhaps, is give you a known FX rate at the start of a reporting period. And Alex touched on one of the previous Markets Masterclass sessions that we ran back at the tail end of last year on FX budget rates. So using this example, if I had set a budget rate when cable was at 135, but I hadn't entered into hedges for the next reporting period, then we sort of saw the consequence of that, where the red line on this page starts to dip and follow the green line, because this hedging strategy is not designed to achieve a sort of known rate for the hedged period, and that's where we had conversations with companies about how do they deal with that, and the rate at which they can hedge sort of moving away from the rate they had budgeted and sort of communicated to the market. So Alex, I'm sure there's probably plenty of examples of this one in practice.
Yeah. I mean, this type of strategy is obviously heavily used by a number of clients, particularly airlines stick in my mind as big users, and typically they'll seek to maintain certain hedge ratios for their dollar book, which is really predominantly they're predominantly buying dollars to pay for the jet fuel. But typically they would have, want to be 80% hedged on their dollar book in year one, maybe 60% in year two, and 30% in year three, etc. And it allows them really to smooth the FX movements into the book, and strip out any immediate impacts, and basically gives them time to pass on any FX movement costs into their ticket pricing, and pass them on to the end users as time goes by. So very common strategy employed by, for example, the airline sector.
Great, thanks, Alex. Almost the final slide that we've put together on this topic. I touched on earlier, walking through the FX risk management strategy and saying that strategy is broader than FX hedging. So FX hedging is part of the overall strategy, but it's by no means the whole the whole thing. On this page, we've tried to bring this to life, and again, we touched on sort of quantitative analysis previously and understanding market risk exposures that the company has, understanding the impacts of those. This is a case study from a piece of work we did for a UK client. We've done many similar examples of this work, but I thought it would be useful just to put up on screen to give people a flavour of what this might look like. And this is a small part of it, but maybe just to talk through it in a minute or two. So on the top left, thinking back to the start point of our risk management strategy formulation, we have the cash flows to which the company is exposed. So this was the first step in the analysis. It was dealing with cash flows only. We also looked at translation risks, but this chart shows the cash flows. The data is anonymized. It's a case study. There's a range of currencies in here. This is a UK retailer, let's say, and it's very clearly one way round, if you want to call it that. It has positive foreign currency cash flows and very little in the way of negative outflows. So its revenue, as reported in sterling, is very heavily dictated by the FX market rate of each of these currencies against sterling. So the chart in the top left is really just helping to visualize the exposures of the company. So this is EBITDA in any one year, and of that EBITDA, what is the currency mix of it? So you'll see that there's sort of 5 or 6 main currencies that are probably going to drive the FX risk in this company. On the top right of the page, and indeed the bottom left, this is just 2 ways of trying to visualize the impact of that risk. So the second step, if you remember in the approach we talked about, was having sort of understood the exposures, can we stress market rates in some way? And in this case, we've shown this as a sort of a value at risk, or a cash flow at risk, if you like. So we looked across a 3-year window. We said, well, let's assume that the cash flows don't change. but let's overlay potential market risk movements onto those cash flows. Where could EBITDA end up, or let's call it earnings for simplicity. So from a sort of average outcome of roughly 500 million sterling equivalent, you can see the risk in year one goes up to roughly 540 or down to 475. In year two, it's greater. In year three, it's greater as we move on and FX rates sort of move away from where we are today. The bottom left is a similar way to look at that risk. It's really just showing a distribution of earnings over that 3-year window. So what is the total earnings? And again, the average you would expect to be roughly 3 times the annual earnings, so 1.5 billion in this case. And then you sort of get a feel for the distribution of risk. On the bottom right, we've then tried to sort of decompose that risk and say, well, okay, of the currencies in question, which of these currencies are driving that exposure? And again, you'll see, no surprises that there's probably 3 or 4 main foreign currencies which largely drive the exposure, and that the other ones are perhaps not relevant. So sort of touching on that risk tolerance point. So looking at your tolerance for market risks and trying to sort of identify, well, where would you deploy your hedging efforts? So if I were talking to this company, I would probably say, focus on currencies, well, the first 4 currencies in this chart, because that's where you're going to have the biggest impact, potentially even just the first 2. So that's really just an example of a more sort of quantitative view of some of the concepts that we talked about at the start of the presentation. We then went on with the company to look at balance sheet translation risk. We decomposed these cash flows into transaction risks and earnings translation risks, because again, companies often take different approaches to hedging those 2 things. And we looked at, again, the aggregate of those risks and went on to answer the question, or to try and answer the question, what is the overall impact of these risks on the company's results, and what ways could we look at trying to reduce some of these risks? So what do we mean by that? Really kind of narrowing that distribution in the chart on the bottom left, and indeed the one on the top right around the average. So giving greater certainty of the outcome of earnings over this 3-year horizon. So I thought that might just be useful to include to bring the earlier discussion to life a little bit.
Yeah, it is. I mean, it's very interesting to see how you would approach it, and how you would engage with clients around understanding those sources and putting it to them in a format that's easy to understand. So that's pretty helpful. Thank you.
And I think, Alex, to your earlier point, when and how can a company's banks be involved, and how can they be helpful? Maybe this is one of the ways in which ourselves, other banks within companies' banking groups can add value, can sort of bring their analytical powers to bear, if you like, because a lot of companies won't have the bandwidth to do this themselves. Treasury teams are generally quite small, let's say, and do they have the same sort of analytical tools that banks might have? Possibly not. So yeah, definitely, it's one of the areas in which banks can hopefully help companies to sort of visualize and quantify some of these risks, and start to answer the question, what am I going to do about them, and how?
Very helpful. Thank you.
And that brings us to the end, at least, of what we wanted to say. I'll maybe try and leave you with some key takeaways. Really, if I was to try and summarize, what have we walked through? Well, first of all, I said that hedging is only a part of a company's risk management strategy. I've talked through the previous page of trying to visualize, trying to quantify the risks, and compare them to the risk tolerance of the company. And at that point, that puts you in a position to sort of determine whether or not you want to try and reduce those risks, to try and understand and articulate what the objective of reducing the risks is. Is it sort of reducing cash flow volatility in itself, or is it other factors, reducing cash flow volatility because that has an impact on the valuation of the company, our ability to raise debt, on forecasting, on budget rates, et cetera, all of the reasons we touched on earlier. So sort of clearly understanding those market risks, the impact on the metrics that the company cares about, that it reports, understanding the objectives of hedging, and I would say articulating those within the company. If we go back to the sort of the budget rate point that we touched on earlier, maybe one example of articulating the hedging strategy is, making sure stakeholders understand what it is that the strategy that's being used is designed to achieve. Is it designed to, make sure the company hits its budget rate, or is it more designed to smooth the FX rate over time? And those two things might be mutually exclusive to an extent. So understanding that that's articulated well within the company. And finally, I would probably leave you with a quote from the Bank of England from Sarah Breeden's recent interview at the ACT conference. So she has said that the Bank of England urges treasurers to prepare for the unexpected, looking for things that could damage the business and think through how you would manage them. So I thought that tied quite well into what we've talked about today.
Very pertinent, very pertinent. Great. Well, thank you very much for sharing that with us. It was really insightful to hear from you as to how you think about some of those risks and objectives. So thanks very much.